ask questions, please connect your camera and unmute. And with that, I hand over to President Lagarde, please.
Thank you very much. Good afternoon to all of you. The Vice President and I welcome you to our press conference. The Governing Council today decided to lower the three key ECB interest rates by 25 basis points, in particular the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The disinflation process is well on track. Inflation has continued to develop broadly in line with the staff projections and is set to return to our 2% medium-term target in the course of this year. Most measures of underlying inflation suggest that inflation will settle at around our target on a sustained basis. Domestic inflation remains high, mostly because wages and prices in certain sectors are still adjusting to the past inflation surge with a substantial delay. But wage growth is moderating, as expected, and profits are partially buffering the impact on inflation. Our recent interest rate cuts are gradually making new borrowing less expensive for firms and households. At the same time, financing conditions continue to be tight, also because our monetary policy remains restrictive and past interest rate hikes are still transmitting to the stock of credit, with some maturing loans being rolled over at higher rates. The economy is still facing headwinds, but rising real incomes and the gradually fading effects of restrictive monetary policy should support a pickup in demand over time. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity. The economy stagnated in the fourth quarter, according to Eurostat's preliminary flash estimate. It is set to remain weak in the near term. Surveys indicate that manufacturing continues to contract, while services activity is expanding. Consumer confidence is fragile, and households have not yet drawn sufficient encouragement from rising real incomes to significantly increase their spending. Nevertheless, the conditions for a recovery remain in place. While the labor market has softened over the recent months, it continues to be robust, with the unemployment rate staying low at 6.3% in December. A solid job market and higher incomes should strengthen consumer confidence and allow spending to rise. More affordable credit should also boost consumption and investment over time. Provided trade tensions do not escalate, exports should support the recovery as global demand rises. Fiscal and structural policies should make the economy more productive, competitive, and resilient. We welcome the European Commission's Competitiveness Compass, which provides a concrete roadmap for action. It is crucial to follow up with further concrete and ambitious structural policies on Mario Draghi's proposals for enhancing European competitiveness and on Enrico Letta's proposals for empowering the single market. Governments should implement their commitments under the EU's economic governance framework fully and without delay. This will help bring down budget deficits and debt ratios on a sustained basis while prioritizing growth-enhancing reforms and investment. Looking at inflation, annual inflation increased to 2.4% in December, up from 2.2% in November. As in the previous months, the increase was expected and primarily reflected past sharp drops in energy prices falling out of the calculation. Along with a month-on-month increase in December, this led energy prices slightly higher on an annual basis, after 4 consecutive declines. Food price inflation edged down to 2.6% and goods inflation to 0.5%. Services inflation edged up to 4%. Most underlying indicators have been developing in line with the sustained return of inflation to our medium-term target. Domestic inflation, which closely tracks services inflation, has remained high as wages and some services prices are still adjusting to the past inflation surge with a substantial delay. At the same time, recent signals point to continued moderation in wage pressures and to the buffering role of profits. We expect inflation to fluctuate around its current level in the near term. It should then settle sustainably at around the 2% medium-term target. Easing labor cost pressures and the continuing impact of our past monetary policy, tightening on consumer prices, should help this process. While market-based indicators of inflation compensation have largely reversed the declines observed in the autumn, most measures of longer-term inflation expectations continue to stand at around 2%. Looking at the risk assessment now. The risks to economic growth remain tilted to the downside. Greater friction in global trade could weigh on euro area growth by dampening exports and weakening the global economy. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by geopolitical risks, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could disrupt energy supplies and further weigh on global trade. Growth could also be lower if the lagged effects of monetary policy tightening last longer than expected. It could be higher if easier financing conditions and falling inflation allow domestic demand, and the unfolding climate crisis, more broadly, could drive up food prices by more than expected. By contrast, inflation may surprise on the downside if low confidence and concerns about geopolitical events prevent consumption and investment from recovering as fast as expected, if monetary policy dampens demand by more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Greater friction in global trade would make the euro area inflation outlook more uncertain. Looking at the financial and monetary conditions now. Market interest rates in the euro area have risen since our December meeting, partly mirroring higher rates in global financial markets. While financing conditions remain tight, our interest rate cuts are gradually making it less expensive for firms and households to borrow. The average interest rate on new loans to firms declined to 4.5% in November, while the cost of issuing market-based debt remained at 3.6%. The average rate on new mortgages edged down to 3.5%. Growth in bank lending to firms rose to 1.5% in December, up from 1% in November, amid a strong monthly flow. Growth in debt securities issued by firms moderated to 3.2% in annual terms. Mortgage lending continued to rise gradually, but remained muted overall, with an annual growth rate of 1.1%. Credit standards for business loans tightened again in the fourth quarter of 24, having broadly stabilized over the previous 4 quarters, as reported in our latest bank lending survey. The renewed tightening mainly reflected banks becoming more concerned about the risks faced by their customers and less willing to take on risks themselves. Demand for loans by firms increased slightly in the fourth quarter, but remained weak overall. Credit standards for mortgages were broadly unchanged after 3 quarters of easing, while the demand for mortgages again increased strongly, mainly because of more attractive interest rates. In conclusion, the Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions. Thank you.
First question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon. Thank you for taking my questions. First question is about the future. Where do we go from here? Are you still confident about the direction? Your fellow board member, Isabel Schnabel, said we're getting closer and closer to the point where you need to have a discussion about how much further rates can come down. Did you start having the discussion today, and what's your own view on this point? Second is about the neutral rate. Speaking in Davos, you gave a slightly different range for your neutral rate estimate than in the press conference here. Why did you change the estimate? Why did you lower the midpoint? What is the significance, or if there is a significance, of this change?
Thank you so much for your 2 questions. First of all, I just want to remind you that by lowering by 25 basis points today our 3 interest rates, and particularly the DFR, we have now cut down by 125 basis points relative to the high level where we were. Number 2, there was no discussion as to whether this decision was appropriate or not. It was a unanimous decision. So all governors supported the decision that was articulated by Philip Lane this morning of cutting by 25%. You will have seen in the monetary policy statement clearly stated that at this point in time, we are still in restrictive territory. And we have not had a discussion, because it would be premature at this point in time, about the point where we have to stop. We know the direction of travel. You've mentioned it in your question, and this is the direction that we will take, at which pace, with what sequence, what magnitude, will be informed by the data that we will collect in the coming weeks and months, and by the analysis that our staff will conduct. We are lucky that for our next monetary policy meeting in March, we will receive a projection prepared by staff, which will be informed by the economic environment as it unfolds, and we will have, in the meantime, 2 additional readings on inflation. Those are data points, granted, but a series of inflation readings are informing those decisions. On R-star, natural interest rate, you will be pleased to see in 8 days, on February the 7th, a publication by staff on the revision of the natural interest rate. And, you know, this is not something that we have discussed. As you know, it's a range, and it's a range that has, that does not give a guidelines or a destination. It's an indication, and it's in many ways a conceptual principle that is elaborated by a number of models, and that's what staff will publish and will comment upon. So you'll have plenty of it to elaborate upon.
The next question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much. I have a question on the economic outlook. You're saying that you're expecting that exports will contribute positively to economic recovery or activity, but if you look at the uncertainties in that world, how much do you think actually this is something which is realistic given the slowness in China, given the Trump administration? That would be my first question. And my second question is whether, given that bleak economic picture and also the disinflationary trend and these restrictive monetary policy stance, why didn't you discuss a 50 basis points cut? Thank you.
Well, I can reassure you right away, we did not even utter the 2 numbers, 50. So 50 was not in the debate at all. And as I said, there was rallied support unanimously by all members of the Governing Council for 25 basis points. Your question on exports, it's an interesting one. We took the precaution in the monetary policy statement to refer to export as a potential engine for growth. Not the main one, but an additional one. And we took the precaution to say, if I recall, provided that there is no trade or additional trade friction, something along those lines. So that's in the economic activity paragraph. And then we talk about exports yet again in the risk section. And we clearly analyze the trade environment, the framework within which trade takes place, and the uncertainty associated with it as a potential risk. But obviously, there are rumors, there are statements, there are assumptions, but we don't have anything that is, clear, tangible, and can be inserted into the analytical work that staff does. So we will be looking very carefully at the numbers that come in, the information that sort of consolidates, and obviously staff will incorporate all that in the work that they are going to do for the March projections. I'm not sure that there will be, by March, enough certainty to actually be very confident. I think we will still be plagued by uncertainty in that respect, and there will be more to come. But as it comes, we will be taking that into account.
And the next question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, thanks a lot. The first one is on inflation. Your confidence in reaching the 2% target is very much based on the expectation that wage growth and services inflation will slow down significantly. That hasn't materialized yet. Services inflation is still around 4%. At what point in time do you need to see hard evidence in a slowdown in services inflation to continue cutting rates, let's say, beyond March? And the second one on a completely different topic. Your Czech counterpart yesterday said that his institution will assess including Bitcoin into foreign currency reserves. And US President Trump has backed the idea of a national strategic Bitcoin reserve. What do you think about such ideas? Is that something the ECB is looking into? Thanks.
Well, thank you very much for your two questions. On, yes, we are confident that inflation will reach our target in the course of 25, and that's 2% medium term, sustainably so. And you are right that there is one particular item which is still resisting. The others are moving down. You know, when you look at goods, when you look at non-energy industrial goods, when you look at subsets of all that, it's definitely moving down. And I have said in previous press conference that when goods are going down to 0.5, we're not going to expect that services will be at 2, because we would be clearly undershooting. But services, and in particular, if we look at the various underlying measurements, the domestic one, the one that strips out anything that has to do with exports, is still resisting. And that's actually gone up a little bit, because on services, we were at 3.9, we moved to 4. We're not data point dependent, but we look carefully at services. And we know that, you know, those services are largely labor intensive, with or without contact. We used to have that distinction in the COVID time. We have less of it at the moment, but it is largely wage labor intensive, and as a result, wage sensitive. We try to measure and to understand wages as much as possible, because it is so relevant for services. And all the indicators that we have at the moment are heading downward and are confirming our confidence that wages in 25 will be going down. Whether you look at compensation per employee, which is quite a useful and relevant indicator, whether you look at the wage tracker that we have, whether we look at Indeed, whether we look at the ratios of vacancy to unemployment, all of those indicators are heading in the same direction. We're not celebrating that, but we are taking note and acknowledging the impact that it will have on services. Some of you will remember that I've also and we have focused on the distinction between the newcomers and the latecomers. We took, for instance, a particular review and deep, tried to have a better and deep understanding of those latecomers that, you know, waited for a period of time until they decided to hike prices. That is clearly the case for insurance companies, for instance, that do not increase their prices on a monthly or quarterly basis, but they generally wait until the expiry of a contract and then they hike prices. So we will be very attentive to how the latecomers, which did hike prices in January to March 24, whether this process under which they caught up with inflation is going to be duplicated this year again. We don't think so. And you know, we do a corporate telephone survey, the result of which you will see tomorrow, because we publish tomorrow. But our understanding from the corporate telephone survey as well, because we ask them, you know, how do you see negotiations taking place? And when do you expect increases? All of that is heading in that direction. So it gives us the confidence that wages are they were down, and therefore will impact the price of services, and that we will see a declining movement in the course of 25. We don't expect, I think we say in the monetary policy statement that in the next couple of readings will still be resistant, if you will, largely because of base effects on energy prices. But from there on, we see this declining path in the course of 25. But once again, we don't look at one data point or one, it's not just compensation per employee. It's not just negotiated wages. It's the combination of it all, because it's a complex matter, depending on member states, depending on collective bargaining agreement and their renewal, all of that. On this matter that you referred to, and whether reserves of central bank should or could include bitcoins, I think there is a view around the table of the Governing Council, and most likely the General Council as well, that reserves have to be liquid, that reserves have to be secure, that they have to be safe, that they should not be plagued by the suspicion of money laundering or other criminal activities. And as a result, I'm confident that reserves will not enter, that bitcoins will not enter the reserves of any of the central banks of the General Council. I had a good conversation with my colleague from the Czech Republic, and I leave it to him to make whatever announcement he wants to make, but I'm confident that he's convinced, as we all are, of the necessity to have liquid, secure, and safe reserves. Thank you.
And now, Aude Kersolek of BFM Business, French television. Aude, please.
Thank you, Madame Lagarde. Are you comfortable with going on cutting rates, whereas the Fed had stopped? What impact do you foresee? And second question, if tariffs are introduced, do you think monetary policy will have to adapt immediately, or is it necessary to wait for the impacts on activity? Thank you.
Well, thank you very much for your question. I'm comfortable with one thing. We are comfortable with one thing, which is to reach our target. We are mission-driven. We want that 2% medium-term sustainable, and we will do everything that is required in order to reach that goal. So, as I said to another colleague of yours earlier on, under the baseline that we have, and with the data that we have received, we can comfortably indicate that we are directionally on this downward slope, pace and sequence of which will be determined by data and will be decided on a meeting by meeting. And for those who would like to have this solid forward guidance, it would be totally unrealistic to do anything of that nature, simply because we are facing significant and probably rising uncertainty at the moment. So this is what we have to do. And we continue to be guided by this sort of threefold analysis, which includes the inflation outlook, the underlying inflation, and the transmission of monetary policy. So are we comfortable doing what we have to do? Yes, absolutely, because we are mission-driven. The second question you had related to tariff. You know, as I said earlier on, for the moment, there is nothing that we can actually capture in terms of policy determination, in terms of numbers, in terms of scope, in terms of, custom line items to understand exactly what is considered. When that happens, then of course it will enter into our assessment and into the macroeconomic analysis that is produced by our staff. But it's far more complicated than it's this way or this way. It's inflationary or deflationary, depending on whether there is, one set of decisions with variable rates around the world, rerouting of trade, whether there is retaliation or not. All we know for sure is that it will have a global negative impact. A global negative impact.
And the next question goes to Silvia Bazzoni of Class CNBC, the Italian TV channel.
Good afternoon, President. Good afternoon, Vice President. So in the statement you mentioned headwinds, and GDP released this morning, of course, were below expectation, especially for France and Germany. So is the recovery delayed, and how long will it take to come out of stagnation? And the second question, you were mentioning before, since December, long-term yields have gone up significantly following especially Treasury sell-off. And this besides the economic divergence between the EU and the US. So are you worried, and how are you assessing the situation? Thank you very much.
Sorry, worried about what?
The yields that are going up.
Oh, yields.
Yeah.
Okay. So Is the recovery delayed? First of all, there is recovery. I think that's the first thing that we have to keep at the front of our mind. We went from a very low 23 to almost double the growth in 24. Now, granted, it is not at potential yet, but it's certainly a recovery. And given the job market, given the real income increase, we have good reason to believe that consumption will pick up and will continue to support this recovery process that we expect to continue. We never talked about stagflation. Q4 was stagnation of growth, but it's one quarter. If you look at the whole year, it's a different story. So, recovery there is. Stagflation there is not. Inflation is going down. And we have recovery. Will it be delayed? We shall see. As I said, it's a process that is ongoing and that has been quite something in the course of 24. So the yield increase, whether you look at the short end or the long end of the curve, yes, it has increased. And it's a global process. It has been predominantly in the United States, but it has spilled over across the world, and the euro area has not been spared of those spillovers. It's largely attributable to spillovers from the US, not only. Partly because of energy prices, but also for other reasons. There is probably less of a downside risk expectation concerning inflation on the part of the markets, which probably explains partly this yield increase. But as I said, largely spillovers, partly Euro-specific. But it doesn't stop our monetary policy from transmitting quite materially. When I look at the decline of interest rates for corporates, the decline of interest rates to households for mortgages, it is really channeling through into the economy. And when I look, for instance, at the consumer survey and their intention to invest, there is clearly an added demand on the housing sector, for instance. So more to be seen on that front, particularly fueled by lower interest rates.
And now Olaf Storbeck of the Financial Times. Olaf, for you, please.
Thanks a lot. I have a few questions on the natural rate debate.
Not
Two.
few.
Few. Can you give us any idea of your views on how the ECB will decide when we are there? So conceptually, will you just take the mid-range of the star forecast, or have you already discussed how to determine that? And do you have any views on the question, as we are getting closer to the level, wherever it is, will the reaction function of the ECB have to change in terms of, do you have to act more slowly or kind of take more time to see how monetary policy actually works? Thanks.
It's a nice question. But let's face it. We are currently restrictive. We are not at neutral rate. This is a debate that is entirely premature. When we get closer to that, we will operate on the basis of a staff research paper, on the basis of the analysis provided by staff, and then that will help us determine how close we are and what our monetary policy stance should be. If you're asking me today whether we should go below neutral rate in order to stimulate the economy, I cannot tell you that. That's pretty obvious. We decide meeting by meeting on the basis of data, and we are not pre-committing to any particular pace. So how could I tell you if and when we arrive at this conceptual principle of the neutral rate, what we will do afterwards? This is going to depend on the data that we receive.
Stefan Rechius of Handelsblatt. Stefan, please.
Oh, by the way, we will be also, I mean, I know staff is going to work very hard on models, but we will be looking at all sorts of information, intelligence, you know, the famous reference to looking out of the window. We will also be looking out the window.
Thank you for the floor. Here I am.
Hi.
Hi. You had a dinner guest on Tuesday evening, which, if I'm not mistaken, was the first time. Could you walk us through the exchange with Ursula von der Leyen and what you talked about and how it feeds or fed into the deliberations of the Governing Council? And my second question, if I may, is on the withdrawal of the Fed from the NGFS. The timing was delicate, just days prior to Donald Trump taking office. Did this exit surprise you, either in substance or in timing? Did you expect it, and what does it mean for global cooperation of central banks? Thank you.
Well, thank you for your two questions. President von der Leyen honored us with her presence at dinner on Tuesday. She was not the first one to attend what I, very immodestly call the president's dinners. Pascal Donoghue, the president of the Eurogroup, had also attended one of our dinners. And it was a very rich experience, which all governors felt could be repeated with other guests from around Europe. So I was particularly grateful to the president that she came, despite the crazy agenda that she has. Let's face it, this week is particularly heavy for her, and she managed to come. It gave us a chance to understand better from her expose, her remarks, what exactly the Commission was going to focus on in terms of competitiveness, in terms of simplification, in terms of keeping the goals but being flexible on the approach. And I think that she was herself, but she can speak for herself better than me, pleased with the exchange that we had, because it took the form of her explaining the policies considered by the Commission in order to restore the competitiveness, in order to incentivize innovation, in order to eliminate some of the red tape, and so on and so forth. But it was also a chance for her to hear from the governors what their concerns were, and to check facts and policy recommendations. So it was, in that respect, really an interesting dinner. And there will be more of those, as I have other guests up my sleeves, which I'm not going to disclose at this point in time. Now, you asked me a question about the withdrawal from the NGFS. The NGFS includes, I think, over 150 countries around the world. We are an active member of the NGFS. We actually provide the scenarios that are used by the NGFS and most members, and we see huge value in this multilateral, comparing of notes, comparing of scenarios, comparing of risks, comparing of policies. I think in this day and age, having a multilateral setting where these issues can be debated and analyzed is of great value. I'll stop here.
And the last question today goes to Elena Savova from the Bulgarian news agency. Elena, please.
Thank you. Good afternoon, Madam President. I have two questions. First, you mentioned rising real incomes. How far is this process gone, comparing the levels the pre-pandemic levels? And my second question is related to Bulgaria. Bulgaria is preparing to ask for extraordinary convergence report. Do you have recommendations for easing this process? And eventual extraordinary convergence report, would it be focused mainly on the technical criteria for entering the Eurozone, or it will take a more comprehensive approach about policies, about legislation again, like the released in June?
Right.
Thank you.
I beg your pardon because I missed the first part of your question. The second part I registered on Bulgaria, the convergence process and all that. But on the first one, what was it?
The real incomes.
Oh, real incomes.
Yes, how far are they gone comparing the pre-pandemic levels?
Yeah, okay. Okay, so on rising real income, it's a fact, and in many member states there has been a complete catch-up with pre-pandemic levels. What has been different from pre-pandemic levels is the level of savings. And the level of savings has increased, has varied over the course of time, but in net terms has increased. And we very much hope that if confidence can be restored, particularly in view of a degree of anxiety and uncertainty about European political development, for instance, that consumers and investors will restore their previous pattern of consumption and investment. On Bulgaria, there is a convergence process that is well advanced. We are marginally involved in the process because we do not pass judgment on anything else than convergence towards inflation, and we look at the fiscal position and the sustainability. But on those fronts, and from what I have seen and the discussions that I have had with the Bulgarian authorities, I'm confident that this process is going well, and the special convergence report that has been asked by the Bulgarian authorities will, I suppose, it's not my decision, it will be determined by the Commission, will proceed so that there can be a review of all the criteria, not just inflation, but all the criteria that Bulgaria has to satisfy. So I'm only giving you a partial answer because the rest can only be given by the Commission.
Thank you very much. That concludes our press conference today. We will be back on the 6th of March, and until then, I wish everybody all the best. Thank you.